Okay, everyone, welcome to All Things Talk. 2020 has been a challenging year for many people. COVID-19 is once in a century pandemic with 50 million cases. We are truly in a global recession. But at the same time, in the last few weeks, we have seen some lights at the end of the tunnel. There will be a new president in the States. Vaccine is coming, and here in Australia, we have the federal government's putting a $200 billion stimulus package. RBA cut interest rate to 0.1%, which is a fresh 30 years low, and also introduced $100 billion quantitative easing. So stock market globally is performing extremely well, and more people talk about we actually have a 2021's global recovery. So is this too optimistic, or what investors should really do in 2021 here in Australia and also globally? So I would like to take this opportunity to bring these questions to the master of investment in Australia, New Zealand. Joining me today is Mr. Cameron Blanks, the managing director of Pacific Equity Partners, or PEP. Just very quickly, PEP started in 1998 and managed over 5 billion Australian dollars. It is the largest, longest running, and also one of the most successful funds in Australia and New Zealand, with over 20% IRR over a decade. So Cam joined PEP since 2002, and before PEP, he was with Bain and Company. He has a MBA from MIT Sloan, and also interestingly received the first class honors back to uni, a super scholar indeed. So Cam, welcome to our program today.
Thank you very much, Eric.
Can you please give the audience a quick introduction of PEP to our audience, please?
Yes, so PEP, as Eric mentioned, has been going since 1998. We're absolutely focused on Australia and New Zealand deals, looking for opportunities with very solid companies with great market positions that are not subject to large fluctuations from things like interest rates and uncontrollable risks. So it's a real focus in our market. We have very deep networks and have been investing in the market for more than 2 decades, so we understand it very well, and we're really trying to make our returns through operational performance improvement on the businesses that we buy.
Fantastic. So can you maybe share some names of the portfolio companies, like case studies, let audience know those are the, you are the guys behind those successful stories of this business?
Yeah, look, we've invested in a lot of iconic brands across a lot of different industries, from Peter's Ice Cream to Hoyt Cinemas to 4 and 20 Pies, and then into New Zealand, Manuka Honey, Griffin's Biscuits, Tegel Chickens, a lot of really well-known consumer brands. We also invested into financial technology businesses like Link and Vida, which is now Equifax in Australia here. So a lot of different iconic brands that we've invested in, and also some business-to-business platforms that you may not be as familiar with, but are very iconic and very big businesses, within their sectors. So probably one of the case studies, I think, Eric, that is worthwhile sharing, and probably the easiest one to describe for us is Peter's Ice Cream. It's something that's familiar to all of us, which is an ice cream company, and it's really in a duopoly here, or two-player market between Peter's and Streets. As you walk into your corner stores, you'll see the freezers in those stores, and they'll be either a Streets freezer or a Peter's freezer. Sometimes you'll see both of them in a larger store. So really a two-player market, wonderful set of brands, very iconic. We actually acquired that business off Nestle. Nestle is one of the biggest food companies in the world, based in Switzerland. And this was a very, very small division within Nestle, and very undermanaged, given it just wasn't getting the management attention and the capital it needed to grow. So this is a classic example of the type of deals that we do, which are corporate carve-outs, unloved divisions of big multinational companies, where we can really, put very focused management with a clear strategy and capital behind that. That was a deal that we only end up owning for just under 3 years, and we sold it to another large global ice cream specialist company called R&R Ice Cream, and so that was a very successful example of the type of things that we do.
Oh, fantastic. It's basically the household brands everywhere, right? So if you go to Hoy's Cinema, buy ice cream from Peter's, that's all PEPs, portfolio companies.
Correct.
Yeah, and also this has been a very busy year. I read PEP's name pretty much all the time on financial reviews and other medias. So there's a bid to Link, the company you just mentioned. I think it's nearly a $4 billion bid to the business. The acquisition of Citadel Group, a software company, and I think there's also Modern Stars, local school and childcare business. Then there's energy. So there's so many things happening in the last few months for PEP. So do you think the pandemic actually, or the COVID does actually create an opportunity for PEP and the PE industry here in Australia?
Look, it does. It obviously it creates opportunities, also risks, and I don't think we take very lightly. The 2021 outlook is quite challenged. I think there's been a lot of stimulus that you referenced, Eric, at the beginning of the session. A very large stimulus by the government, a lot of support with JobKeeper and the like, and that will come to an end at some point and needs to be replaced. So, as we sort of think about our investment style and the type of investments that we're looking at very defensive industries, ones that will do quite well in a recessionary environment. Although we haven't seen that to date, we've obviously consumers at the moment in Australia have actually more money than they probably did, ironically, before the start of the pandemic, with things like JobKeeper. People aren't traveling as much, so they're not spending as much on those sort of discretionary items. So right at the moment, the Australian consumer's actually in pretty good shape, but we are concerned about how that translates into 2021. So, the type of companies that we are investing in are essential services. They're not discretionary spends, or aren't exposed to discretionary spending. So, it's a very focused and targeted set of companies that we're looking at, and I think that's the theme that's going to emerge in the public markets as well as the private markets, where companies that have good defensible earnings and essential services in a COVID or post-COVID world are going to trade very, very well, and those businesses that are sort of very exposed, to consumer spending and to recessionary environments, probably aren't going to do very well over 2021. So that really informs us to think about where we're investing during this upcoming period.
Understands. You did mention about the stimulus potentially withdrawn from the Australian economy sometimes 2021. Do you think that it will be the potentially the largest challenge for funds managers like yourself? And also, I think at the same time, we do have a situation where globally we have disputes on trades. Surely we have a new president in the States. Do you think the global environment will have more impact on Australian economy than the domestic factors? Or on the other hand, considering you have investment in this large domestic business but potentially have global exposures, will this kind of domestic and global situation does, if you put these factors together, maybe also put a bit more pressures on the companies in 2021?
Yeah, look, I think I guess it's hard to crystal ball gaze exactly what is going to happen. I mean, as you imagine, we were sitting here in February and none of us saw the pandemic really panning out the way that it did. So I think we've got to be a little bit careful when we crystal ball gaze. And I think this really comes down to the way that we think about investing where you do think about some of these scenarios, like if there's some trade restrictions on certain goods and services, be very careful about investing in those sorts of services. So we fortunately in our portfolio, we've been investing over the last 4 or 5 years in things like health, in essential energy services, whether it be smart meters or embedded networks or remote area power for gold mines and the like. When you look across, we've got an education platform, but it's in domestic vocational training and the like, which we think will see quite strong rebounds. We've got private hospitals, we've got medical device businesses and the like. So it's really thinking about your portfolio construction and how it's going to be impacted by some of the trade and other factors that you talked about. So again, I think when you start to think about the Australian economy and where people are going to get affected and where they're not, it's very important to think about that in your investment strategy. So I think we personally feel like we're in a good spot. I think there are going to be soft places within the Australian economy. And I think, that one of the things obviously the Australian government's going to try to do is to stimulate demand, not through JobKeeper and that type of stimulus, but investing money in infrastructure. And that we think, and the energy transition, as you think about Joe Biden coming in with a much more climate change focused strategy, and it's thinking about how some of those sort of policies are going to impact different businesses, and then making sure that you're investing in the ones that are on the right side of that discontinuity.
Yeah, you did mention the world of essential services. I think that is also one of the key investment philosophy for PEP as well. So I mean, with all the industry you mentioned, infrastructures, energy market, etc., they are really in a way they kind of anti-cycle in a way. So I guess that could be why that's the portfolio business is still doing really well even at this kind of challenging time, I guess.
Yeah, that's right. And look, sometimes we have some really interesting impacts happen through the COVID period that we didn't expect on our portfolio. For example, we have a business called Auto Pacific that manufactures 90% of tow bars in Australia and New Zealand. So this is for four-wheel drives and people who either are tradies or recreational vehicles and the like. So 90% of tow bars. So when the pandemic hit, obviously a lot of car sales sort of dropped dramatically, and that was actually a challenging investment for a few months. We were quite worried about it, but surprisingly, given the increase in domestic travel and also accelerated depreciation for trade vehicles and the like, we've seen record sales in that business. It's way over budget. And these are some of the impacts that you wouldn't have actually thought through happening as you come through. But again, it's an essential service. We know exactly how many cars are on the road. It's a 90% share business, so it's basically an essential provider of services into the Australian and New Zealand economy. And again, it's really thinking about what are the businesses that are going to be less impacted than things that are maybe more on the peripheral of the economy.
It's kind of fascinating when I think about it, where PEP invest into the word you use, these defensive companies. But when we talk about defensive allocations in terms of investment portfolio, people will think about cash and government bonds. They're generating less than 1 or 2% now. But looking at the histories, the IRR for funds managed by PEP delivers over 20% for this long term. So that is not to me, that is definitely a fantastic return for even we say that's defensive strategy. So I think this also goes to the question that, I mean, what is your selection criteria? I mean, to deliver these kind of exceptional returns in decades, it must be some sort of magic recipe there behind the scenes, right?
No, it's not magic. I think it's about having two characteristics that are essential to all the investments we make. One is a defensive characteristic where we're very confident about the downside within a business. That the worst case scenario we can have is maybe a 5 to 10% return, even if everything goes badly. But just pricing everything in that way is not sufficient. The other side of the coin, and the other part of the equation that we think about very strongly is how to improve the performance of the company. So there needs to be the upside opportunities that sit within the investments that we make, and that's all about management execution. And our history tells us that if we incentivize our management teams well, we align them around the strategy that we agree, and then we support them to execute. That's really what drives the outside performance. The asset selection is what delivers the downside protection. So it's thinking through asset selection, who's running the businesses, how they're running the businesses, and then also having a very clear view towards exit as well. Ultimately, we are a buyer of businesses. We're a value-added investor during the ownership period, but ultimately we need and want to sell these businesses after that period of transformation. So thinking through all three of those parts of the value chain, or investing value chain, if you like, is really, really what we do and what we focus on here at PEP.
Yeah, you does mention the word of value add, which is another thing I want to ask you, because considering again, take Peter's for ice cream for example, that is a massive business. It's a big successful business already, and to buy out this kind of business and all similar business, it's not really the money. It's really, I mean, for their shareholders, they're gonna look at what sort of value adds you can potentially bring into the business, right? So do you mind to explain what sort of value add do you guys usually bring into the portfolio companies?
Yeah, look, a lot of it's about getting management focused around a strategy. So, the Peter's ice cream one is a very easy example to explain. And this doesn't mean that Nestle, a massive company, is not smart. They're very smart, but they operate on a different agenda. When you're sitting in Vevey in Switzerland and thinking about your global portfolio of $100 billion business, a relatively small, I mean big in Australian context, but relatively small division in ice cream in Australia, where you don't own an ice cream business anywhere else, you start to have global policies like you cannot market to children because Nestle is is at its heart a coffee company. And so caffeine is not something good for children, so a global policy comes through. You're a very large chocolate business, so the ice cream division has to buy chocolate from your central division. The accounts receivable needs to sit in Singapore because that's where you do all the accounts receivable. Well, the fact is you're trying to receive and collect monies from corner store owners in Australia and New Zealand. You're not really connected to your customers, so you end up with stock out. So a lot of it's to do with getting local focus on local businesses with the right incentive, providing the clear strategy and also the capital to support the delivery of those strategies. And that's really it sounds simple. It's not easy to execute, but at a high level, that's as simple as it is. It's about getting really, really clear about the journey and the transformation journey that we're on with management and supporting them to do that.
Simple is always the best, but it's never easy to make it simple, right? It does require expertise and hard working, I presume. If I put these two things together, I mean, talk about the investment philosophy of PEP and also how do you think about the Australian economy and all that. So I guess there will be certain industries or certain sectors you will be focusing on in 2021 for the fund.
Yeah, absolutely. We're continuing to focus on a lot of the same sectors that we have because they are, in our minds, quite defensible. So things like education, health, energy, transportation in the right sectors. There's obviously some transportation assets like airports that have been quite challenged, but in the right sectors, in the right way, again, for essential services. Software as a service, we've just bought a business called Citadel that is in the health IT space. So again, digital economies, digital assets. Link that we've obviously in the public domain that we're looking at. Again, it's administration services and things that are actually tied to a number of accounts, not balances. So if you do get a correction on the stock market, it doesn't affect it. So it's thinking through the types of businesses that are less impacted by macro conditions.
So as a funds manager who delivers like 20% IRR over decades, and with the challenges we have now domestically and internationally, at the end of pandemic, hopefully the vaccine will work very soon. What are sort of advice you can give to investors? Now is the time for us to rethink about a investment strategy. What are sort of advice you want them to take away for 2021?
Obviously just some observations, I think,
yep.
Worthwhile sort of informing that it's pretty clear that interest rates are going to remain low for a long time to come. There may be an outbreak of inflation, in the medium to long term, but certainly in the next few years, interest rates are going to be very, very low, which does have some distorting effects on asset valuations and the like. And so I think thinking through, where do you get yield and how do people deliver returns to you? Because I think that overwhelmingly the interest rate environment is very important to sort of think through the risk reward that's presented as a result of that. So I think firstly I would think about that. I would also anticipate that we are going to see some real recessionary environment coming up in Australia. Certainly nobody hopes for a recession. It's not a nice thing to go through. I think we've been in a technical recession in 2020, but just given the COVID environment and the like, overall the economy's been shielded from that. I don't think that is going to be the case into 2021. Certainly not in the latter part of 2021 as some of the stimulus rolls off. So really thinking about your portfolio in that sort of environment. It's hard to imagine that that's going to happen given the stock market continues to rise, but I would suggest that a lot of that rise is actually being driven by low base rates, low interest rates, as opposed to fundamental growth. So once that interest rate can't go much lower, there'll be a little bit of quantitative easing. I think those recessionary things need to be really factored in as you think about a defensive investment strategy.
And even that is defensive, but they can still expect some good returns along the years because we have a value-add funds manager and has been demonstrated doing so for over 2 decades. So Cam, thanks very much for your time. I think I take a lot from today. I'm sure the audience will really benefiting from the conversation. So I think I do wish you and the family health and joy, in this challenging time. And I do wish to see you next time and share more of your insights and investment knowledge with our audience. Thanks a lot for your time today.
Thanks, everybody.